Hello everyone! I'm going to discuss a topic that seems quite simple, but at times people forget. We all want to make big bucks on our cash. If we strive for more, you always need to remember that you take on more risk. I want to discuss the relationship between risk and return when it comes to investing. Risk simply is the possibility of you losing money that you initially invested. And returns is simply the amount you get or lose on the invested amount. As mentioned earlier, the asset which gives higher returns is generally expected to have lower levels of risk. Typically, it is said that cash investments like savings accounts, high interest savings accounts, and term deposits are low risk. In return, you get paid some interest, which is typically the lowest earning amount out of all the assets out there. However, there is a different risk you undertake. So, even when you keep your money in a bank account offering you 2% returns after tax, there is another kind of risk that you're taking: inflation risk. Your investment might not keep pace with the inflation or the increase in the cost of living, which will reduce your purchasing power in the future. Now, on the other hand, if you look at property and shares, they have typically given more return than cash investments. Shares usually gives more than property, but we live in a culture that loves property more than shares because it doesn't take on the risk of shares. However, it gives us a performance that is satisfactory to us. However, when you add a loan to the purchase of a property, you increase the risk because a downturn in the property market means that you multiply the loss not just on your funds, but the borrowed funds. My point really is that when it comes to investing, you need to be realistic on what risks any goals you have might entail, and you need to sit down with someone who will explain everything to you so you make an informed decision. What are you waiting for? Connect with us today.